what all you have to go through, what these guys are going through when they're analyzing deals, they're looking at markets, they're trying to make a decision of where they can buy. They finally find 50 properties they can make offers on. They narrow it down to 5. They make 5 offers. They get competition back and forth, and and they finally get one under contract. And that's the time where they should be celebrating, but the reality sets in of, how the hell am I going to raise this money? So I want you to tell that story from your perspective, because I'm going to layer that into the conversation.
Yeah, I had plenty of that shit in my life.
And you could even tell, firsthand if you want, of like what all you guys went through, the process it took to finally get to the point where you had something under contract. And then those oh shit moments, and then also if you could echo the closer it got to the closing date, how those nights got more and more restless.
Yeah, so it's hardest, Christian, when you're starting out, but it never gets easy, and it's because it's sort of progressive. Our first few raises were small deals in upstate New York, and it was back when Carrier had announced in Syracuse, New York. So that's where we did, I think, was where we did our first syndication. We were only raising $2-3 million. And we had a strong connection with a large number of accredited investors through our market orientation tours that we used to do back then. But we had never tested it. And it was a different dynamic because these guys were buying market research and market orientations from us. And then you say, okay, we want you to write us a check, because we'd like to buy this piece of property in Syracuse. And wholly different dynamic. And even though we had a large group of accredited investors, 10% of the people we were talking to were accredited investors. The rest of them were just buying for their own account, and we gave them this opportunity, and some of them, back then, a lot of them didn't even know, about being a fractional owner or an LP interest. So fundamentally, the first thing it is education, and a lot of education before you get a comfort level with these guys, even though we were meeting with them face to face and spent a week with them. Most of what they were really looking for, and no one asked the question. They never asked the question such as, can I trust you? It's that, because it's not in the human dynamic. Matter of fact, the more you get to know people, the more reticent they are. And can I trust you? What do you know? How smart are you? How experienced are you? Those are the questions they want to ask, but they never get a chance to. Because of that, they're just uncomfortable doing it. And that's the way human nature is. So the first thing you have to do is get that out of the way. And mind you, on those initial raises, you got a finite time frame. And so far, because you've never asked before, no one has ever said yes to you. And you don't know the process to get to yes. So that's the first part of it is that you have to understand what it is that people are not asking you, but are holding them back from making that investment. And it's like, can I trust that my money is going to get back to me? And that you've got enough knowledge, enough experience, and are you honest, and so forth. So that always strings out the time. So then you would, even on small raises, you'd think, I look back at it now, it's like raising, because I see it all the time today, you're raising $2 million for this, that's a chip shot. It's, but I forget that's where we started, and it was, I probably sweat those deals more than anything else. Because there was my reputation on the line. It's like he had a $2 million raise and he couldn't get it done. So So there was a lot of sleepless nights as we, can we talk the seller into giving us the extension on the purchase sale contract, or, how exactly were we going to get from point A to point B. And I remember out of desperation, we got pretty good at convincing sellers to not just give us an extension, but come in on a temporary LP basis to give us more time to get it done. And if they didn't, then, usually that meant we lost our earnest money. And it only happened to me once, but it was $100,000, and it was $100,000 I couldn't afford, and that today would be more similar to about a $200,000-300,000 earnest money going hard and not getting it back. It's kind of sentimentally attached to that money. And you think it's going to get better, and you get a bigger stable of investors, and you keep getting more and more people that are saying yes to you. And all that it does is that then you start thinking, well, we did that $5 million raise. We should be able to do a $7 million raise. And then your next one is like, can we do a $10 million raise? Can we reach a little bigger? And towards the end there, our average raise was $20 to $30 million. And it was the same process. I never ever got comfortable we were ever going to get any of those done. It's just that we knew more people that would say yes to us, but we just didn't know how far to press that. And towards the end, we had 4,000 accredited investors we were working with that at one time or another had said yes to us. But 400 of them were pretty much saying yes every time we asked. Just like what we were doing, we liked them and they liked us. And that allowed us to have a lot more surety of closing. But it's been 6 years since I was at that company. And they had one in Atlanta that was a great property 4 years ago. $17 million raise and couldn't get it done. So if you like sleep, you probably don't want to raise capital on a short time frame, because there'll be a week or two right before that close that you will be up at night and tempted to get on the phone at 11 o'clock at night and start calling investors, which that will definitely get you.
Yeah. I mean, you mentioned that it's even more difficult for the newer folks. Talk about, I mean, you're having probably as many conversations with sponsors as I am. Talk about what you're seeing these guys dealing with as they're working through a difficult market, not only difficult for deal flow, but also difficult for raising capital. What do you think they're dealing with?
Well, I'm sure they're dealing with the same thing that I was dealing with, back when we were doing it. The newer investor, the biggest problem is you're an unknown, and it's hard to point to a track record when you don't have one, and you say, well, I've done a couple of deals in the past and they were successful. That doesn't really constitute a track record. It's good. It's good that you have that experience, and you can point to that factor. But, I guess maybe the biggest mistake we made is, so I had been syndicating before I started RealSource, which was just doing multifamily. That was what I was talking about in the recent raises, but that was the last group that I worked with as a syndicator. But before that, I was doing neighborhood shopping centers, and we did that for about 7-8 years, and I had a really good track record in that. And I was pretty excited about that as a career for me, except for I ended up with when I first saw the internet, I figured retailing might be a little bit of a question mark in the future. It was before Amazon or anything, but you were just starting to see the .coms show up. We were on .edu because that's how we were getting our research done. Where most of our research was being done out of the University of Texas, because they had a fabulous real estate department there. So I knew I needed a new gig. And it's funny, I've syndicated three types of products. That's been retail, neighborhood-sized shopping centers, and then multifamily. And then when I left that company, some of the guys quit at the same time I did, and which we've dealt with at PREIshare. They came in and started syndicating self-storage. And what's interesting about it is that when I would talk to my old investors, which many of them I'd made millions and millions of dollars for, and I'd say, hey, Tom, I'm working with some guys that were working with me at Real Source, and they're out not doing multifamily anymore, but they're doing self-storage, and want to know if you're interested in taking a look at a deal that they've got going. And they go, this is Mike Anderson, right? Yeah, the guy that used to be a Real Source. When did you leave Real Source? And you'd say, well, a couple of years ago, and I'm just helping these guys out. They go, why are you doing self-storage? Because we know the Mike Anderson that was doing multifamily housing. I like that guy, but I don't know who you are. I had conversations that tracked very closely to that. What's your experience in self-storage?
That's like David Zeff when he talks about all the guys that said, no, you're a office guy.
Yeah.
In California.
Yeah.
He can't be a multifamily guy in
Yeah.
Arizona.
They always say, well, some of the principles still apply, And then that's your opportunity to say the most important principles you know about me is I'll watch out for you. I'll always have your back in a deal. And if you've had a great track record with that, and they know that you're investor centric and you care about the people that are investing with you, that's the most important thing. You're past that hurdle, But then you just got to say, well, here's the differences between them. We have an understanding of it. We got a model around it, But it's pretty hard for somebody to say no to you when you've made them a lot of money in the past. Not that they owe you, but you kind of get that sense. But like I said, I don't ever remember feeling easy about any race that we started out on. We got them done. Sometimes we had to get some pretty creative, boys to get them done, but we got them done.
Explain that feeling for people who don't understand what that feeling's like. Maybe they're not even in real estate. You get a property under contract. What's that initial feeling there? And then what is the feelings as you're getting to your earnest money being hard? How do those feelings change when you're getting to closing table? You don't have all the money already in the bank.
Yeah, see, I guess there's an initial sense of euphoria when you get a deal under contract. And then as soon as you get it under contract, you start questioning. I always did anyway. And I think if you're conscientious about what you're doing, you start questioning is the performer right? Is that assumption out of market norm? Was I conservative enough? I've never had a contract that was accepted where I didn't, first thought went through my mind is I paid too much. Especially if it wasn't a long drag out battle to get to a number or terms. So then you start second questioning that, but you're euphoric over the fact that you got the deal closed. And that's the funnest part of it, it's chasing the deal. And then for the longest time, we never really faced early on, because there wasn't a lot of fierce competition like there is now. We didn't have to put up big earnest monies. And especially if we could show that we had capacity to close, like the loan was already approved, we had a line of credit or something like that, which at times we did have, then the earnest money wasn't a major factor. But, for us, when they got up to 100,000 or 200,000, we had a few of them at 500,000. We had one that went 500,000 that went hard right after the due diligence period, and we only had 15 days to do that. So then you're just betting $500,000 you're going to get your raise done. And you know me, like I keep saying, I've never met a dollar that I didn't fall in love with and wanted to keep it. I was always terrified that I might not see those ones again. Yeah, so there's that aspect of it. And I think if you get to this point where you're really comfortable with that, either you got an incredible team around you or incredible service providers, people you can count on, or you're just not paying attention. And I see a lot of people that just don't pay attention. It's just, I'll get it done, I'll get it done, and I'll get it done. But when the earnest money's gone hard and you got a week left, you're looking for a rich uncle, you're looking for somebody that will, you can pay a high interest rate to just to get a bridge loan to get it done. Done a few of those.
What's the closest you ever came to closing without having the money secured?
Well, I told you I had one that failed. I didn't raise, and that was 100,000. We've had a couple things that, a couple times when we got to it and we were 48 hours and $2 or $3 million short on the raise. As I look back on it though, and this might be an interesting tip for some of the new guys. What was interesting, if like you were the seller, Chris, I'd come to you and say, okay, so our contract price is $15 million. I've got debt lined up for $9 million. That's yours. And I've got another three and a half, $4 million lined up. So we can close this and you can have that money now. And psychologically, that was a good place to be because it said, the second you say that money's yours, they've already run the cash register and they're thinking about whatever they're going to go do, then their next thing, what they're going to do with the money. But you need to carry a couple $1 million of that and let me finish the syndication. We have this amount of interest in it. I'll give you all the notes from everybody we've talked to. And we got 3 or 4 of them closed that way. And then we would just go backfill them. But I would rather, because if they say no, that's your only option. You're in big trouble. And that will make you sleepless, and that will give you ulcers, and that will, I would say, make your hair go gray. Mine just fell out. But having what I wished I'd had is a strong private lender, not bank money or anything else, because you don't want to go through all of that process and all that rigmarole. And most banks and institutional lenders are not going to be in second position anyway. But private money will do that. Private debt will do that. And it wasn't as big as an option as it is now, but there's a lot of guys that do private debt. Matter of fact, I've offered private debt in the past to other sponsors or people that are just trying to bridge out to get to closing. And that would always give me the surety to close. And if the interest rate was high enough, then you got real incentive to start making calls and finishing up that raise because you might be paying 14, 15% on your money. So you don't want to have that hanging out over there too long.
So when we were talking about, the credibility, how do you feel the sponsor profiles that we're building will help these guys build that credibility?
Yeah, I really like that. It's interesting from a couple of standpoints. One, it'd be interesting based on the information that they provide and providing that you can vet that information, which there's ways to do that today. Or it might be interesting from the things that they don't provide. If you're good and you know it, you want everybody to know it, and you want to give hard evidence of those facts. That gets you past that credibility gap right off the bat, and puts the onus on you, not anybody else. But if you don't provide a lot of information, the first thing I would say, what is it that you don't have that you wish you did have? And then go find that person, to fill in those gaps. Because what speaks volumes is when nothing is said at all about an important question, like, how credible are you? Yeah. I love that idea. I'm fascinated that you guys are going to implement that.
And then, you've already seen us do some of these launches for people where we're tapping our internal list of accredited investors. What do you think that's going to do for these guys?
Tapping up.
No, tapping it, where we're sending out a boost to our
Oh.
network for them.
Yeah, in the last year or so, your database has gotten pretty valuable. I've seen that several times when they get those boosts. To me, that's as good and maybe better in some respects than being able to have private equity in your pocket or private debt in your pocket, because if you're just at that I'm stuck point, but I'm close, and I've got most of the money raised, so somebody looking at the deal fresh new right now is thinking, oh, they don't have much to raise. Somebody's thinking this is a good deal. I might not get a chance to get in on this, And if all of a sudden you get 20, 30 guys that are right at the end of your raise, that puts a lot of pressure on that group of investors, and it puts a lot more surety in getting your raise completed, and I love that idea. And if I remember right, you guys so reasonably priced compared to what you get. The problem is for you guys is you can only use that so many times,
Yeah, which is why it's limited on how many sponsors we
Yeah.
work with.
Yeah. But it would give me a lot of comfort to know that I could use it if I needs be. But you also run into the possibility of saying, hey, we've hit that list twice this week and we're not going to get into anybody's spam filters. So you got to be judicious about how you use it. But I've seen it work miracles.
Well, and you've seen what we've been doing now on the full launches. In fact, you helped fund Ian's, and you saw them clear that one, so you could probably speak to the success there. But
Yeah, and that was done with a boost, wasn't it?
Yeah, that was done with a full launch. Yep.
But it was a full launch and then it ended with a boost.
Yep.
Yeah.
That's what got him over the line.
Yeah, and you saw what happened. I watched that video, and I love Ian, but he must have said in there, did I say we were oversubscribed? He must have said 15, 20 times. And he was saying it after they'd already completed the raise, so, or closed deal is when he recorded that video. And I was like, I think he was more proud about the fact, not so much the fact that he closed the deal, but he had more guys interested in investing in it than he had real estate to buy.
Yeah.
Then what he didn't say 15 times when we closed the deal, he said 10 or 15 times, and we were oversubscribed.
Yeah.
And that's huge. And what a confidence builder that is, Truth of the matter is you need to be oversubscribed anyway, just because you have a lot of fallout when it's time to write the check.
Yeah.
But there was that boost, I think, gave him enough that he had plenty of margin. So the 15, 20% of people that don't write the check that were committed to it, you had enough additional investors interested in it that you could, you had a fallback position.
So now that we're designing the launch differently to where it's more accessible, but also there's a lot more control in the sponsor's hands. Essentially, we're going to give them an initial test on all the major platforms. We're going to show them the results and then allow them to choose how much additional ad spend they want to put into any one of those. How do you think that they can best utilize that?
Well, first of all, what I like about it is it's not putting everybody in the same box, because some deals just don't fit in the same box as the next deal that you're looking at. Could be because of the market, could be type of product, it could be experience of the sponsor. But it allows you as an organization to put them in the controls and say, let's design something that specifically works, and let's do some market testing ahead of time to get a sense of what that's going to look like. It's a far better approach than saying, yeah, give me $50,000 and I'll give you 250 accredited investors, and you as the marketing company for those investors have no idea if 50,000 is going to cover or not. And if you go over, then you're probably not going to be too excited about maybe it was a sponsor, wasn't that great in returning phone calls, or if it was just a market that no one had ever heard of, or a deal that was kind of wonky in some way. There's so many variables in that you just can't say a $50,000 investment fits everybody. It doesn't, you know. And the other side of it is that you could put up $50,000 and marketing guys could get it done for a quarter of that price. And you'd say, well, wow, why then didn't I just get another 250 investors out of that? So it puts control on both sides in the way it needs to be. And then I have seen so many investors that, you know, we had a couple of them that come out of the gate and had $5 million commitments right out of the gate, and they didn't need to go any further, you know. So they could have just said, oh, "We'll shut it off." I wouldn't have. I would have said, even though I want to go like Ian, I was oversubscribed. I've got plenty of money for my next deal, you know, and I'm out looking for it right now so I can get that money spent. That's where you want to be, but on their side, it gives them, you know, listen, I'm going to take my wife to Europe. I know I'm right in the middle of this raise, and I wasn't expecting to buy this property, but I want to put that on pause for a minute because I want it fresh. When I'm calling, and I don't want to be calling from somewhere in Europe to get to those guys in a timely fashion. So it gives them the control too. You know, how they do it, when they do it, you know, and how much they want to spend on it, and how they want to spend it. But what I love about it is it's all going to be on some empirical testing. So you guys are going to test for them and say, look, it looks like the best way for us to go is with this kind of advertising on these platforms. That seems to be giving us the best bang for the buck, you know, which as far as I know, no one's done that before. You know, so I think that's huge. It gives them all the information they need to plan.
Yeah.
You know.
So I know we probably already have this on video somewhere, but can you talk about the strategy you guys used to use when you would get towards the end of the raise and launch a marketing campaign?
Yeah. So one of the things crowdfunding platforms didn't happen until late in my career. We didn't have Reg Cs until maybe for the last five years, Obama. So whenever Obama was, but that's the length of time we had, you know, and I'd been syndicating for probably 20, 30 years before that. So when we would get down to the very end of it, we would launch a Reg B, and then we'd also launch a Reg C. Reg B allowed us to tap our own investors, no problem on that. And we get most of our raises done that way. But what we found out is that we wanted to continue to expand that stable of investors that we could work with because we were buying bigger deals and we were buying more often. And so there was always this thing where you got to establish a relationship and you don't want to do it right when you're trying to close a deal. So what we would do is we'd wait until, and I hate to admit it, but sometimes we wait until we had the thing completely done internally. And then we would launch but just done. Because we knew, like I said, 20, 30% of those guys would fail to write the check when we asked them to make good on their soft commitment. But we would go to like Real Crowd or Crowd Street, and knew both of those guys really well. Knew Adam and Ian, and they knew what we were doing. But we'd give them the $20,000, $30,000 to get on their platform, and we would then finish out the raise on that. But we just kept it going until we were oversubscribed, not only by 20 to 30%, but maybe we had 150% of the equity we needed to commit it to. And that meant that we're that much further ahead with this. Sorry, we couldn't take you on this one. We got another one coming next month. We're that much further ahead on that next one. And that did start getting to where I got pretty comfortable with that. Because what we did is we just manufactured more demand on limited supply.
Mm-hmm.
And people got to know that, hey, if you're going to do a deal with Real Source, you better pull the trigger quick.
Yeah.
'Cause
Last
if-
time we were at BEC, we were talking to Neil, and he always said he was just waiting for the next time that Michael Anderson would put out a deal so that he could jump into it first.
Yeah, no, he's doing that. But it's interesting. That's just a complete shift in the dynamics, you know. And that towards the end, we're really good at doing that. And we decided as just a tool just to build relationships that are not under pressure of close. And that's how we got to such a big number of investors that we were working with.
So would you say that you didn't become comfortable with your capital raise until after you could do Reg Cs and launch those advertising campaigns?
Yeah, because we were launching. Yeah, we were doing simultaneously, but the Reg C is what allowed us to get on the platform. We knew we had a lot of Reg B interest, because we'd been at it for such a long period of time and had such a large number. But there was just certain percentage of those, like I said, 10% of those were pretty much always ready to invest us when we'd call. Of the 4,000, so 400 did almost all the lifting for us. But we never knew when one was going to retire, and we knew that based on our success, whatever their objectives was when they went into it, it's like, well, I want to put my kids through college, so I want to have a college fund of $300,000 or $400,000. Well, they'd get to $2 or $3, $4 million. Kids already in college, they got enough money to put all their kids through Harvard, and it's like, wait a minute, why am I doing this? Why am I not just enjoying the money myself? And then so they would drop out, or be a little bit more, I've got surplus cash, I don't know what to do with it. What do you got? And you could just see when you get to the point where they'd be starting to question, why am I continuing to invest? And so we knew what the attrition rate was for that. And that's what we use those platforms to keep that fresh.